You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. All right, everyone, we are back. Welcome back. Actually, welcome back. Hamish Hodder, you're back.
I'm
back.
I'm better now, a little bit. Yeah, I'm mostly better now. Oh my God, what an ordeal over the past couple of weeks. It's funny because I want to talk about a little bit about New Zealand, which was so incredible, but it's also kind of overshadowed by the week that kind of followed it.
Yeah. First of all, we do have to apologize for the podcast not being here last week.
I know we
were thinking about pushing through, but like Hamish was so sick that we were just like, look, dude, just rest up. And I think honestly, you guys, if we had done a podcast, you guys would have picked up on it as well because Hamish was just in a bad way.
Yeah, I couldn't
so we
go.
Thought we'd just postpone it and
I apologize for that. And I jinxed it as well because the week before I literally said, how good has it been that we've never missed an episode in the past like 18 months or something. So
we actually had a comment on this.
Yeah.
One of the comments in response to what you said on that podcast was, hey fellas, great to listen. If you missed, great to listen to you as usual this Saturday morning. If you missed one, it would indeed irretrievably ruin my weekend. So
we've ruined someone's weekend.
I do have to apologize to you, good sir, that we have indeed ruined your weekend last weekend. So
yeah, I do apologize for that.
Our apologies, but hopefully it doesn't happen again. That was the first one we've missed in a very, very long time.
Yeah, and to give you some context, I came back from New Zealand at the beginning of the week and I'd already been a little bit sick over there. I had kind of like a flu over there and I came back and I think just the adrenaline of coming back from a holiday or whatever, I started to think I was feeling better on the first couple of days of that week. And then it was like Wednesday, Thursday, Friday, I think it just got so bad. Like I couldn't go 5 minutes without coughing up like all kinds of stuff. I was coughing up blood. Like it was hot. Like I there's not a chance I could have got through an hour of a podcast. I do apologize for that, guys. But
you sound a lot better now than what you were sounding. So
yes,
hopefully that's good. But anyway, illness aside, how was New Zealand? Did you have a good time?
It was great. So we went skiing for a few days, and I mean, as I said, I got sick kind of halfway through, so the back half of it was a little bit quieter. But I'd never been to New Zealand, and I had never skied in New Zealand before, and the snow there is it's fantastic. It was great.
Yeah, how good's Queenstown? I love Queenstown.
Yes, yeah. The vibe there, the culture there is so...
It's great. Everyone's
great.
there to have a good time. Yeah. It's party, it's adventure, snow sports, everything. Yeah.
There's so many people... Yeah.
I was going to say, Java Ferg Burger.
Yes, how good. Yeah. Everyone is obsessed. It's crazy.
They are.
Who is this Ferg guy with his bakery, his what is it, gelato as well, and then the burger place as well. What a little
he's got a monopoly.
It is actually insane because everybody, I was saying this, a couple of my friends had been there before and they were hyping it up so much. And despite hyping it up so much, it still exceeded expectations. And that is so rare. Like it's so rare that a business can be hyped so much and then still exceed your expectations, which is, he's got
How
something.
much does the burger cost there? Are they still really well priced?
They were like $13 to maybe $17, I guess, depending on what you got, maybe 15 to 17, something like that. So
it's good burgers,
it's
good prices.
Pretty reasonable. Yeah,
absolutely. Well, I'm glad you had a good time, mate. Although I'm sorry you got so sick.
I got the ups and the downs of the past couple of weeks. But
Hamish, this is what happens when you leave your house.
Exactly. This is why. This is exactly why. No, I'm kidding. This is exactly why I don't leave my house. 51 weeks of the year. No. But no, I'm excited to get back into it because it is like it was a long week, and I did make a video in the end. I kind of struggled my way through a video, but I'm excited to get back into stuff. It's funny because I obviously had the holiday week off and then the sick week off. So it's like 2 weeks and that's like a long time to not really be doing all that much. So I'm energized. I'm ready
I'm
to
good.
go.
I'm glad. All right, well, let's get into it. I don't even know. Was the last time that we spoke? Do we literally have still have the Queen?
Yes, we didn't speak about that. That happened while I was in New Zealand. Yeah.
Oh, okay, yeah, okay. So that's a pretty big change that's happened since I last spoke to you, and it's actually prompted an interest I've had, which is like, how does the British royal family make money? So I thought that maybe I'll go through that in today's episode, but we've also got a lot to talk about in terms of inflation. US and UK inflation data has come out since the last time we spoke. Twitter shareholders and the Elon Musk situation, that there's an update there. We're also going to talk about Paramount Plus and their streaming service, and also a little bit of news on YouTube as well. So we do have, there you go. When you skip a couple weeks, then all of a sudden the news backs up on you, doesn't it? So
yeah, we'll see what we get through today. We will. There is a lot to break down, but with that said, today's episode is sponsored by Sharesight, which is an application you can use to track the performance of your stock portfolio. So you can bring in all of your trades either automatically by connecting your broker using Excel, or you can also do them manually one by one if that's what you want. When you do that, it will help you track all of the gains and losses in your portfolio. So capital gains, dividends. If you have dividend reinvestment plans, it will do all of those calculations for you. Currency gains if you're buying shares internationally or you hold foreign currencies. And then you can also use it for when it comes to tax time. So Sharesight generates up to 12 different reports that can be used at tax time to work out things such as capital gains, dividend income, and more. And at the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. So use that link, sign up to a free plan, track up to 10 holdings for as long as you want, or you can also use that link to sign up to a premium plan, and you'll get 4 months off a yearly subscription if you use that link. So go check it out if you haven't already. And thanks to everyone who has used that link and is supporting our podcast.
Indeed. Where do you want to start today, Hamish?
Where should we begin? I think maybe we should cover some of this inflation stuff quickly. And just one thing before we get to the inflation stuff, I guess it's kind of on the back of the inflation stuff, but at the time of recording this, we won't know what the Fed decision is, but it will have been out now. It's expected to be 75 basis points, so we'll kind of see if that rings true. And I guess maybe we'll be able to talk about that a little bit next week. But that's kind of on the back of the inflation data that was released last week.
So let me talk to you about that. We'll start in the US. Obviously, when we're talking about the Fed, we're in the US. So inflation, the inflation figure was for August was worse than expected as rising shelter and food costs offset a drop in gas prices, the Bureau of Labor Statistics reported last Tuesday. So they said the consumer price index for all urban consumers rose 0.1% in August on a seasonally adjusted basis after being unchanged in July, the US Bureau of Labor Statistics reported. However, when looking over the past 12 months, oh my gosh, I'm so out of form, Hamish. What's going on? Looking over the last 12 months, the all items index increased 8.3% before seasonal adjustments. So June, July, August, we've gone 9.1, 8.5, and now 8.3. So declining, definitely not enough to obviously feel comfortable, so the Fed still has to do what they have to do. But interestingly, on a seasonally adjusted basis, it was actually up by 0.1% in August.
You had
something to say?
All I was going to say is it is interesting because the kind of the headline numbers are not, yes, they were worse than expected, but they're not terrible. I mean, a 0.1% increase is a very, very small increase. But what is kind of, I think the real negative story around it is the fact that the energy was down massively. So the fact that it was still up 0.1 leads you to think, okay, was there something in the core that went up massively? And I think that's what you've got.
Exactly right. That's exactly what I was going to say. Yep. So core CPI, think about this. Core CPI, which strips out food and energy components, advanced 0.6% from July and 6.3% over the past 12 months. So think about that. That's taking out food and taking out energy and all of a sudden has gone up a lot. So it shows you that for overall, that means that, well, energy would have gone down a lot, which it did. This is from the release. Quote, increases in the shelter, food and medical care indexes were the largest of many contributors to the broad-based monthly all items increase. These increases were mostly offset by a 10.6% decline in the gasoline index. The food index continued to rise, increasing 0.8% over the month, as the food at home index rose 0.7%. The energy index fell 5% over the month as the gasoline index declined, but the electricity and natural gas indexes increased. So housing, food, medical costs rose, but oil prices fell a lot to kind of counteract that. So yeah, exactly what you're just talking about. I wanted to chuck in a little follow-up as well, because you mentioned this, I think, last time round. Eggs, Hamish.
Oh, yes, importantly,
eggs,
the breakfast menu.
Yes, the breakfast surged another 2.9% and are now up 39.8% for the 12-month
those pesky
period.
chickens, they're not working hard enough.
they need to increase their output. Come on. Oh, dear.
They need to
Anyway.
increase their output. One a day is not enough. Crack it up.
Twice a day. Oh, we need you to work the night shift as well. Sorry. Golly gee. Yeah, so overall, this wasn't exactly what the market was expecting. They were hoping for inflation to settle after being seasonally adjusted. However, it did not. And because of that, the S&P fell 4.3% on the Tuesday that this was released. The Dow fell 1,300 points. That was equivalent to 3.94%. Treasury yields leaped higher as the 2-year note, which is most closely tied to the Federal Reserve interest rate moves, surged 0.13%. I don't know if you call that a surged 0.13 percentage points to 3.7%. So there you go. That was US inflation for the month of August. Do you want to talk about what the Fed's now going to expected to come in and do about it?
Yeah, so the Fed's expecting a 75 basis point. They're coming in. There's someone actually, I swear it was like Turkey or something, was like, had like some kind of massive interest rate increase. I'm not even joking. I think it was something like that. Okay,
Really?
maybe I'm making that up, but maybe someone can fact check me on that. I swear there was like a 50% increase in interest rates or something somewhere. But the Federal Reserve is not doing that. They're looking to do 75 basis points, so 0.75%. As we said, it's going to be released by the time you're seeing this podcast, so you guys will already know. Some people think it will be 1%, but the consensus at the moment is kind of 0.75. That would, of course, raise the federal funds rate to a range of 3 to 3.25. So it's continuing to go up quite dramatically from basically zero that it was not too long ago. Interestingly, the 1-year Treasury bond rate rose to 4.1%, which essentially tells us that the market is expecting the federal funds rate to approach 4.1% over the next year. So that's like 1 to 2, maybe 50 basis point rate hikes. So that's kind of what the market is pricing in at this point, which is interesting because, of course, inflation is still very, very high. And I don't think it's out of the realm of possibility, even though we don't know. I don't think it's out of the realm of possibility that there could be, 4 or 5 more rate hikes to come, depending on how long inflation takes to ease. It's a good sign that energy is easing. And hopefully that flows into other things such as food, for example, which is heavily impacted by energy in other parts of the market, transportation. But we'll just have to see.
The thing that worries me, concerns me, the headline rate, we've gone from 9.1% to 8.5 to 8.3. That's good because it's going down now.
Yeah.
But the thing that gets me is it's still at 8.3%.
Yes. Yeah.
Just think about what that means. Versus 12 months ago, prices are still going up by 8.3%. Even if they're going up by less and less over time, they're still going up by a massive chunk. And that's obviously too high. So
Yeah. Well,
like a lot of people are like, oh, if inflation comes down a fair chunk, then maybe the Federal Reserve won't even have to raise interest rates. And I'm like, man,
yeah. Well,
I don't know, because imagine if it was just like, instead of going up to 9.1% and then coming down to 8.3, imagine if it's instead, like back when it was 7%, it just slowly increased up to 8.3. Then the story would be totally different.
Yeah.
It'd be like, it keeps increasing. Oh my God. So it's like, man, the 8.3 number would still be the same, but the narrative would be totally different. But it's still 8.3% inflation at the end of the day. It's kind of scary.
Yeah. And I mean, think of it this way. If you have 8% inflation per year for 3 years straight, just 3 years, that's 26% inflation over that 3 year period, which is like a quarter of your expenses, let's say on average, increasing, which is massive. That could be tens of thousands of dollars, right? So this level of inflation, yeah, you're right. It's too high, and we've already been in this period for a very long time. It won't be long. I don't think before 3 years will have passed, and we can look back and see what the damage of this short period of time really was, especially in other regions where inflation is already double digits. 10% inflation per year, that's your expenses are compounding at a massive rate at that point. So, and that's just kind of the average. I mean, if you look at your real expenses, depending on where you live and that sort of thing, your expenses could already be up 25%, 30%. So, hopefully they get on top of it soon. And I'm not quite sure about the market expecting just 1 or 2 more rate hikes. I wouldn't be surprised to see the federal funds rate approach the long run average, which has been about 5.4% since 1970. Currently at 3%. I wouldn't be surprised to see 3 more 75 basis point rate hikes at this point. That would not surprise me.
Yeah. I looked up, I just quickly opened Excel to just do a quick example. $10,000, something that costs $10,000, inflating at 8% per year, will obviously cost $10,800 1 year later, then $11,664 the year after that, and then $12,597 the year after that.
Yeah.
So that's the compounding effect, because of course it's 8%. These period, like it's 8%. Whoa, hang on. Last year we also had 8%. So it takes us to a larger number, which takes us to a larger number again. So there you go. Yes. Anything more to say on US inflation?
No,
we'll talk about it next week anyway, because we'll actually know what the exact number was.
Yeah, exactly. No, I think that's it for now.
Okay. Yeah. I'll just quickly squiz through. I'll go back to the podcast document. UK inflation, a similar story. I mean, it's a global economy at this point. Everything kind of, everybody gets affected in the same way when these big global events happen. So UK inflation slowed in August on the back of a fall in fuel prices, though food prices continue to rise as the country's cost of living crisis persists. So same basic headline as the US. The consumer price index rose 9.9% over the past 12 months, according to estimates published last Wednesday by the Office for National Statistics. Fractionally below a consensus forecast of 10.2% among economists. It was also down from July's figure of 10.1%. So they've gone from 10.1 to 9.9. Month on month, consumer prices rose 0.5%, fractionally below forecast. Core inflation, which excludes volatile energy, food, alcohol, and tobacco, was 0.8%. Was up 0.8% month on month. Wow. And 6.3% year on year.
That's a massive core increase, 0.8%.
Yep.
So
when you take away energy, shows you how much the energy has actually calmed these inflation figures for this month anyway.
Yeah, and it'll be interesting to see how other numbers change going forward. Because food is fairly reactive to energy, but will food costs come back down, or will they just remain high? I mean, in a lot of categories, you'll see inflation surge, but when inflation eases in energy, for example, you won't see declines in other areas. So it'll be interesting to see what happens with food, especially with a large part of that being kind of at home food delivery. It will be interesting to see kind of if food prices do actually end up coming down, actually seeing deflation, or whether they just have a slowdown and prices kind of remain at this elevated level, far above where they were just a couple of years ago, for example.
Yeah. Quote, a fall in the price of motor fuels made the largest downward contribution to the change in both CPIH and CPI annual inflation rates between July and August 2022, the ONS said in its report. And yeah, I just added a note. This is something I wrote last week. While it's not necessarily something to get super excited about, it's certainly better than inflation accelerating.
Yes, it
considering the UK's particular circumstances with the kind of Europe energy crisis as well.
Yeah.
A few weeks ago, new British Prime Minister Liz Truss announced an emergency fiscal package capping annual household energy bills at £2,500 for the next 2 years. Yeah, we spoke about that, didn't we? With an equivalent guarantee for businesses over the next 6 months and further support in the pipeline for vulnerable sectors. The Bank of England is set to raise rates by either 50 basis points or 75 basis points, and I believe that happens tomorrow as well. So we'll probably have a fair bit to talk about next week.
All right.
But should we leave inflation?
We'll leave it there. I've got a little bit of kind of entertainment. Well, it's not entertainment news. It's business entertainment news. We're not gonna have a Kardashian segment on the Young Investors podcast. And in entertainment, Leonardo DiCaprio.
No, maybe we should chuck that in.
Maybe we should. He's dating a 27-year-old. He's broken the mold. A couple people will get that. I want to talk about Paramount, streaming service, and they're looking to make some more moves in the space. As we've seen kind of recently, Warner Brothers made some changes, some announcements, cutting back spending. We've seen other streaming services launch. So there's a lot of chop and change going on at the moment in this space. So Paramount is kind of one of the latest to make a move. So they're looking to consolidate some of their streaming services. So currently they have 5 different streaming services, which I've never understood why some of these companies have they've just segmented everything out into little bits. So they have Paramount Plus, they have Showtime, they have Bet Plus. I don't know what that is. I don't know what most of these are actually, but Pluto TV, and they have Noggin. I think Noggin is like a kid's. It's like Nickelodeon. I think that's what that is.
I love that name. How good is that name? Noggin.
Yeah, I guess having like a kid's one kind of makes sense, although you could probably package it together in some way. But so they currently have 5 different streaming services, and that of course doesn't include all of the other ways they distribute content through cable channels and licensing and that sort of thing. But currently, most of their original television series that they historically have produced and then put on Showtime, the cable channel, things like Billions and Dexter, currently they're all available on a Showtime streaming service, which we haven't heard all that much about. It's kind of been this quiet service that you would get if you had the Showtime. If you had access to Showtime on cable, it would kind of make sense that you would get the streaming service so you can watch it more flexibly. But it's not been it's not up there with like HBO Max and all of these big streaming services that people are kind of talking about. Now Paramount is looking to merge Showtime with their flagship service, which is Paramount Plus. And I personally think this makes so much sense. And there's kind of a couple of reasons behind it. The first is Paramount doesn't actually produce that much movie content. So if you have Paramount Plus, there's not all that much new content kind of coming out. They have a huge library. They've been around for many years, Paramount. So they have this huge old content library of a lot of classic films, but they don't actually produce that many films yearly relative to like Warner Brothers, for example, and Disney certainly. So I think it makes sense for them to kind of combine the two together.
I think I was just going to say, I think if to be able to do multiple streaming services, you have to be clearly the top dog.
Yeah.
So if you're like Netflix, maybe Netflix times 2, you're just like this behemoth streaming service. Maybe you could get away with segment. Oh, you want Stranger Things? Oh, you have to sign up to this one. Oh, you want Bridgerton? Sorry, that's on Netflix too. You have to Netflix. But like, yeah. But you get what I mean. Like, it's kind of like a competitive advantage there. But I think if you're something like Paramount, where you know you're way in the rearview mirror, you're a long way behind in streaming.
Yeah.
surely your strategy, which I'm sure they're now coming to, is you have to throw all of your eggs into the same basket and say, look at how full and amazing this basket is. You know, you want this basket.
Yes.
I think that's what you have to do. That's got to be the play.
Yeah. It's been really interesting because you have all of these media companies that have kind of pulled back their own original content and started to launch their own streaming service. But as a result, it's kind of spread all of the good content fairly thin across a number of platforms because, you know, who makes good movies is not just a couple of film studios. There's a lot of small film studios and media companies that produce great films. So it's kind of all been split out. So it kind of makes sense that at the very least, just to begin with, within these media companies, they would consolidate what they have rather than splitting it even further within the company. There's probably going to be even more consolidation between companies because even with Paramount putting everything together and Disney, let's say, putting everything together and Warner Brothers putting everything together, even still, that's 1, 2, 3 plus Netflix, 4 streaming services that you would have to imagine. And then all of the many other ones that people may want to get, Peacock or whatever. There has to be more consolidation because people are not going to, even in the US, for example, people are not going to have, I would imagine, at least more than 3, 4 at the most.
I don't think people, services. I reckon most people probably don't have more than 1 or 2.
No, yeah. Most people will be 1. Maybe you switch in and out of other ones. But yeah, there's certainly you're not getting all 10. You're not you're not going down the list and getting all 10. So that's kind of one thing. And then the other thing is TV series, of course, represent the majority of content that's consumed on streaming services. So I think it makes sense that they would put their TV assets into their flagship product. I think that just makes perfect sense. Essentially, they're not the first kind of company to make this move. Warner Brothers, just a few months ago, they announced they're going to be combining HBO Max and Discovery Plus into some new service that they're going to announce next year that we don't know what it's called yet, but they're going to be combining those two together. And then you have Disney. Even Disney offers a bundle between Disney Plus, Hulu, and ESPN Plus. So I think this move makes sense.
Yeah, and beyond that, Disney, I could kind of understand their reasoning. They kind of kept Disney Plus for all of their Marvel, Star Wars, Nat Geo, everything that's kind of, PG or whatever. And then they'd have Hulu for the more mature adult content, drama, and ESPN Plus for all the sports. But I think even Disney now are realizing that, hang on, we got to put all our eggs in the same basket as well, because now obviously you can get all of the more mature adult kind of not adult content, but for more mature audiences on Disney Plus as well. So even they've made that strategic change to be like, no, just put it all on Disney Plus.
Yeah,
it's what we're advertising like crazy.
Yeah.
So I honestly wouldn't be surprised if like eventually Hulu just fades out of existence as it's just all Disney Plus. But we'll see.
Yeah, it'll certainly be interesting to see how these platforms continue to move over time, because some have been very, very strict on what content. So some have cut back a lot of licensing, and they're really saying, hey, if you want Paramount content, come to Paramount Plus. Whereas others have said, hey, get Paramount Plus and you'll get some of our original content, but some of it, or a lot of it, we're just still licensing out to other services or to cable channels and that sort of thing. So it will be interesting to see kind of what decisions these businesses make and whether they commit to keeping all of their content and being like, look at our awesome, amazing library, or whether it's partly licensing, or whether they lean licensing and the streaming services an afterthought. We'll definitely continue to see some big moves, especially because a lot of these media companies are losing a lot of money on these streaming services. So they're going to be making changes over the next couple of years to make this business work for them and figure out what it's going to look like. Definitely some more changes to come, I think, from this space.
All right, cool. Anything else on that?
Nope, that's it. That's all.
All right, cool. I'll fly through this Elon Musk business. There's not too much to talk about. So our next bit of news is that Twitter shareholders have approved Elon Musk's acquisition
Ooh.
that he now
doesn't want to do.
Exactly. So Twitter shareholders voted last Tuesday to approve Elon Musk's $44 billion bid to buy the company and take it private. Twitter shareholders approved the takeover offer with 98.6% of votes cast at a special meeting in favor of the deal. Based on a preliminary tally of the votes, the company said after the polling closed on Tuesday. Twitter shares, interestingly, barely moved on the news. And even since then, they still have not moved. It now sits at $41.68. So a fair way away from Musk's offer, like a considerable way away. His offer was $54.20 per share.
Right.
So that shows you that
that's even
like with all this approval,
yeah.
like investors are still very, very doubtful that this deal will actually be forced through.
Yeah.
I just did the quick maths, and Elon Musk's offer represents a 30% premium to the current stock price.
Wow.
30%. That's unusual.
Yeah.
I don't even know. Like one that we'll probably go through is Activision Blizzard, but I think that was running at like a 10%.
It was like
spread.
10 or 15 or something like that. Yeah. This is much bigger, obviously.
30% is whew.
Yeah, it would be interesting to ask like some legal experts to look at this and what their kind of view on it is. And yeah, maybe it's just, I guess it's one of those situations where the outcome is relatively uncertain, or maybe the outcome is that it's unlikely that this will go through as a result. The stock price is, reflecting that. But yeah, very interesting kind of situation. Yeah.
Yeah, the vote comes. I'm just reading an article here. The vote comes as Musk seeks to scrap the deal, casting doubt on Twitter's self-reported percentage of fake accounts and alleging the company was not forthcoming as it should have been with its explanation of the calculation. Twitter stood by its figure of less than 5% of monetizable daily active users being spam or fake, and it said it provided Musk plenty of information meeting the requirements of the deal. Twitter sued Musk for allegedly breaching the agreement, and the case is currently making its way through the Delaware Court of Chancery, with the trial expected to begin in mid-October. The judge in this is where things get interesting, right? So the judge in this case recently allowed Musk's camp to revise his counterclaim against Twitter to include allegations made by a former Twitter security chief who recently filed a whistleblower complaint claiming egregious securities failings by the company. The whistleblower, Peter Mudge Zatko, Mudge seems like is a like a nickname when they do it in inverted commas, testified before a Senate panel earlier on Tuesday. So the Wall Street Journal notes former Twitter security executive Peter Zatko, who was fired by the company in January, told the Senate Judiciary Committee on Tuesday, this is last Tuesday, that Twitter executives, Twitter executives' incentives led them to prioritize profits over security, echoing his whistleblower complaint. Twitter has pushed back against the charges and said he was making misleading statements. He was called before the committee to provide more information on his assertions. Democrats and Republicans raised concerns about the user data potentially being exposed to foreign intelligence agencies. Mr. Zatko at the hearing reiterated his claims that foreign agents... So this is where I'm starting to get a little bit confused because I'm like, how is this related to the Elon Musk thing? Mr. Zatko at the hearing reiterated his claims that foreign agents working for Chinese and other governments may be employed at the company. Last month, a former Twitter employee was found guilty of spying for Saudi Arabia by accessing private user information in exchange for money. Twitter's security team, quote, had been contacted and told that there was at least one agent of the MSS, which is one of China's intelligence services, on the payroll inside Twitter. The Chinese embassy in Washington didn't respond for a request to comment. This is where I'm just like, what? How is this related to your spam and fake accounts and the Elon Musk thing? It says Twitter has argued Mr. Musk got cold feet after market conditions deteriorated. Last week, Mr. Musk got court approval to amend his suit to include aspects of Mr. Zatko's assertions.
So
how is this related?
I don't know how that's related.
I don't know either. How does this like bolster up Elon Musk's argument?
Yeah, I don't understand. I don't know. I don't understand how that's related at all.
Maybe just
Who knows?
factors in that it's like the management team are not doing their due diligence. They're not being they're not reporting or not exploring things as thoroughly as they should be, whether it be spies on the payroll or the number of fake accounts they report in their financial documents.
Yeah, it's
regulatory filings.
That's crazy. Yeah, the bots thing is like I recently I feel like it's gotten a lot worse recently. I don't know. I admit I've only been using Twitter this year, but I feel like in the past
it's one last hurrah before they all lose their jobs. Try and bring in as much advertising revenue as possible.
Yeah, I don't know.
I want you to double the bots. Double them. We're going to hell anyway, guys.
2x. No, that's yeah, I don't know. I don't know.
If anyone is like a legal expert or can understand why on earth that factors into the Elon Musk situation, please let us know.
Yeah, I just think it's crazy they can force the deal through. That seems so weird that there's not just I presume there's a clause that says if he breaches the contract, he pays this amount. And he's trying to avoid that. But I didn't know that they could. It's just wild that they can force the deal through. It seems so weird. Like you must pay.
Yeah, I don't know.
I don't know.
Well, I mean, by the sounds of things, they did enter into a binding agreement.
Yeah. Yeah.
So I mean, it's a binding agreement. I mean, don't sign it if you don't plan to go through with it, kind of thing.
Yeah,
but
I guess
at
that
the
makes
same time,
sense.
Yeah, I don't know. We'll have to watch this one. Any thoughts on that or?
I don't know, honestly. That's
nothing to add. Thanks, Charlie.
Yeah, well, I guess we'll have to wait and see what happens. Was it mid-October was the was the trial? Yeah. I don't know.
Have too long to wait. A month or so. Less than a month.
Yeah, I don't think I have any particular insights on that, to be honest.
Yeah, fair.
Okay. You want to talk about YouTube a little bit? Because
talk about YouTube.
It has a special place in our heart. YouTube is going to start paying for Shorts content, which we obviously make. Wait, you make some Shorts content actually?
No, not really.
Oh, okay.
No.
Well, yeah, I definitely. I don't think I've ever made a short, so this doesn't really affect us. But they're going to start revenue sharing for Shorts content.
So kind of like what TikTok does.
No, so it's a little bit different. So,
okay. Wait, what does TikTok do? Yeah, you take us through. So I won't derail you like I usually do.
No, so TikTok, we can start with TikTok. So the difficult thing with this kind of content is that the ads are not attributable directly to the content, right? So when we post a video, the ad is on our video. It's in the video. Whereas TikTok, for example, the ads are between maybe two different creators' content.
Right.
So they have to be a little bit more tricky about, like, you're not watching a TikTok and then halfway through the TikTok there's a 15-second skippable. Like, that would be that would be kind of crazy. So it's how do you attribute the ads to the creators? What TikTok has done so far, which has been kind of laughable, is they've just had a creator fund where recently they upped it to $1 billion, and it's $1 billion over 3 years, and essentially they just pay out from that fund, spread equally across. I think they must have some kind of partner program as well.
Based on views, I'm guessing?
Based on views, right? So they're doing it,
right.
Yeah, so that they're essentially attributing each view across each TikTok equally. There's no kind of distinction there or anything like that, but it is kind of laughable. I saw a couple people were posting screenshots of like their earnings. One person had 25 million views and they earned $100. which is absolutely horrendous.
Rubbish.
And then I think Mr. Beast posted his, and he said he had over 1 billion views, and it was like $15,000 or something like that for over 1 billion views. So it's that's really bad, and it's laughable. It's not structured in a way where they're actually getting paid a revenue share. It's just been out of this fund. Like so TikTok obviously makes a bunch of revenue, and then they're like, here, have a little bit of, have some crumbs. So that's kind of been the way that TikTok has done it. And to be fair, that's the way that YouTube did it up until this week, up until this announcement. They launched a creator fund, or they called it the Shorts Fund, in 2021. and it was $100 million. So it was even less. It was even less than TikTok's, and they didn't give it out to most creators. They would specifically pick certain creators who got certain engagement and views, and then it was basically a program where they got feedback and then paid them a little bit of money. But now they're actually looking to move into a revenue share model. So Neil Mohan, the Chief Product Officer for YouTube, said on Tuesday at the annual creator event made on YouTube that starting next year, the company will pay a portion of revenue for shorts distributed based on the videos that get the most views. So instead of kind of when we run ads, an advertiser pays a particular amount for those ads, and then we get a split of the ads that are on our channel. Instead of that, they will tally up all of the revenue collected from shorts, and then you will be a part of that pie. You'll have a little slice, 10 million views, 50 million views, and based on the proportion of your views to the overall views, you'll be able to get kind of a pro rata amount of that revenue.
Interesting.
So yeah, they said YouTube says that every month, as I just said, it will pull together ad revenue, and then of that sum, an undisclosed percentage is allocated to creators, and then YouTube will pay 45% of that amount. So it's not clear at all. They haven't been clear at all about what the percent is. With us, for example, it's always been 55%. We get 55, YouTube gets 45. It's been like that since the beginning of the partner program in 2007, I think, or something like that. Or whenever they started the partner program. I'm not sure when it was. But it'll be interesting to see how they play it with shorts, because one thing that YouTube, and I'm sure YouTube can change our percentage. I'm sure they can just do it whenever they want to, but they will get a lot of backlash if they do that. So they're kind of stuck, I think, paying out 55%, and it's a pretty generous revenue split, I personally think, given that YouTube manages the infrastructure and everything that's, all of the advertising and everything. They manage everything. We just have to create the content. But it will be interesting to see how they structure the deal with shorts, knowing where they might be kind of locking themselves into a certain rate. I would imagine it's not going to be as generous as what they've got for the main YouTube content. I don't know. Do you have any thoughts on that?
I think that they're just going to, because we're so early, it's like it wasn't that long ago that Shorts had a beta in its logo. It was Shorts beta. So I think we're so early, and it's still so hard to monetize, or really, short form, like ultra short form video content is still very difficult to monetize, whether it be Facebook and their Reels, TikTok with their platform, or Shorts. That I think they just want to, they don't want to commit themselves to anything, because you're right, if they then change their commitment, which they may have to do because of some business factor, revenues change or whatever, because we're still very early, so things will chop and change. But if they said that they were going to do one thing and then they had to change it, then they would just get crucified. Because all the creators who have all the followers, it directly impacts them. So all of a sudden, they're going to be like, oh my God, I can't believe YouTube's changing this thing and now I'm going to lose out. And of course, the audiences will then be like, oh, let's boycott, let's go back to TikTok. So I think it's just like, at this early stage, we'll keep the details to ourselves until we can figure out a business model that works for us, but also works for the creators. I feel like they just, you're right. Imagine if YouTube changed the percentage payout to creators and made it less.
Here's the thing. They are going to do it one day. Like, there is not a chance. If you're asking me, okay, over the next decade, do you think that there will never be a time where investors are basically pressuring YouTube, or where YouTube is struggling to grow and they're looking at ways they can grow easily, the levers available to them? Do I think that they will change that percentage over time? Yes. I personally think at
some point,
I think they will. They'll probably try and do it slowly over time.
Very slowly. Yeah.
But there will be a big fuss that will be kicked up. But the other thing is, with their competitive position, there's not all that much that I think people could do unless there's a rival platform that's competing, because there's currently nowhere else you could post video content and get anywhere near the same kind of revenue, or at least not
Yeah.
even just direct revenue, but the just access to an audience that you can promote other things. But yeah, it is. It would be crazy to see if they just came out one day. Yeah, we're changing it to 30%.
Yeah,
Everyone would just
they get crucified.
Yeah. Look, I mean, if they lowered, I mean, ad revenue is already not that big of a part of what YouTubers generally make on the platform, because you can take other sponsorships where you get more of a share of the revenue. So if they lowered it significantly, it would just incentivize you to just be more inclined to turn off ads and just run your own sponsored segments, more sponsored segments. Like right at the start, you just turn off AdSense. YouTube gets nothing. And then right at the beginning, you do a 30-second, 15-second ad read. You do one in the middle. You do one at the end instead of running. And there's 3 ads. You probably make 3 times the money that you make from YouTube AdSense.
You can have all the ad revenue and YouTube can have none of it because you've turned monetization off. But then you'd need to be established already, because if you turn monetization off, your videos wouldn't get pushed to anybody because YouTube just wouldn't make money off
That's
it.
the big question, right? Would YouTube, I guess,
of course, they'd be like, no, we're not making money off this video. Show them that Mr. Beast video with monetization turned on.
Yeah.
Absolutely. It's interesting. We'll see what happens. It's early, but this whole space is early.
Yeah.
Despite its popularity, I think that's the crazy thing, is it's so popular. So now these companies are like, how do we monetize the, how do we get our advertising in there? What's an effective monetization strategy for the insane popularity of these kind of ultra short form bits of content?
I mean, the problem with online advertising, and this is something I think I'm learning more about over the past couple of years, and certainly a lot of people didn't see coming, is that, everything is about engagement, and the advertising just has to follow what people are engaging with. And at the moment, people are engaging a lot with this kind of short form video, and it just so happens that it's that form that doesn't really cater to advertising. The ads are smaller, like physically smaller. They're viewed for a shorter period of time. They're clicked far less. All of these things mean advertisers pay far less for these ads. So that's kind of something that Facebook is facing a problem with, which is advertiser dollars are funneling into Reels, and advertisers are paying far less. YouTube is probably going to experience at least somewhat of a similar effect, where if people are consuming more shorts, then advertisers will be spending less money on typical YouTube ads and more on short ads. The money just kind of follows the content being consumed, but it's not necessarily one-to-one how advertisers will spend money across all of these different social media platforms. So it will be very very interesting to see what happens here.
Yeah, I also think that advertisers are just being so silly when it comes to advertising on like TikTok, because they're just like, I don't know if you noticed, but they just run like just branded ads like what you would see on the TV. Yeah. It's like, if you do that in an environment where people are just looking for quick hits of entertainment, you're going to get left behind. The best advertising I've seen done on Reels, TikTok, whatever, is where you scroll into it and you don't actually realize that it's an ad, because it's just one of those entertaining TikToks.
Yeah.
And then there'll be something in there which gets a product across or gets a brand name across. But it's actually it's like an in disguise funny old TikTok.
Yeah.
I think advertisers they need to go with that model, because I feel like, you get, there's like a creator that we were talking about in the office. I can't remember her name. She's been making these videos where she makes like a really short, like cinematic, like product for like eggs or toast or just something random.
Yeah.
And she's getting wildly popular. So it's like, advertisers find her and get her to do that same video, but with your product.
Yeah.
It's like, do stuff like that. Don't just be like, oh, and by the way, Commonwealth Bank now offers this type of savings account.
Yeah.
It's like, no. Anyway, so I think advertisers need to get a lot better.
Yeah, and even things like targeting. I mean, the information that an advertiser is getting from what TikToks you enjoy is far less valuable than, like, if I go the extreme example, what advertisers get from your Google search behavior, right? Your Google search behavior is going to give advertisers a much better picture of what you're willing to spend money on than what type of TikToks you watch. So that's even just another aspect of targeting that makes these kind of ads more difficult. But yeah, it's a fascinating space. Did you see Netflix is going to be trying to sell their advertising space for $65 per 1,000 impressions? So that's their CPM.
Wow.
It's way above.
It's pretty good.
It's like, I think a typical television ad is kind of $20 to $30. Cable maybe a little bit more than that, like $10, $30. So yeah, it will be interesting to see how they perform, but they're hoping to get significantly above market. $65 per 1,000 views is massive. That's huge.
When does that start? When does ad supported start?
We don't know. I think it's supposed to be early next year
Okay.
in developed ad markets, so probably the US. I think they usually test in Australia, which is kind of fun for us because we're kind of a smaller. We're like a mini test market. Same with New Zealand. And New Zealand is kind of a test market for Australia, but like we're like a little test market for Western kind of countries.
Because we're kind of like America, but on a much smaller scale.
Yes, yeah.
That's pretty much it.
Yeah.
Dear.
No,
all right, shall we leave that one there?
Yeah. Yeah. What if we?
I want to talk to you. I've got this quirky story. We'll leave it to the end because it's not like super stock markety. I've been really interested over the past little while. I'm actually making a full channel video on this. How the British royal family makes money. Because obviously with the passing of the Queen and the new King and all that, I got really interested because I read this article and I won't spoil
NFTs.
it, but I was
right?
NFTs. They have a lot of NFT pressure. Actually, the senior members of the royal family are not allowed to engage in commercial agreements.
Right.
They're not allowed.
Okay.
They are forbid. They done get forbid.
Okay.
So they're not allowed to go out there and actually make money. They're only allowed to act in their official duties.
Right.
So with that said, I wanted to ask you, get your ideas on this.
Okay.
What do you think the net worth of the Queen was before she died?
The net of so do they give the net worth for just the Queen separate?
Just the private individual Elizabeth, Queen Elizabeth II.
Well,
not the monarch.
Okay.
Just the individual.
I have no idea. I didn't even know they
I didn't
measured.
either.
I didn't even know they measured that.
No, it's kind of it's a guesstimate. Like Forbes has guessed it.
Okay. Okay. I don't know, like 100 billion. I don't know, more than that. I don't know.
That was what I thought. I thought, oh god, she's got to be like the richest person in the world.
Yeah.
Her net worth is $500 million.
Okay. Right. All right. So she's not even a billionaire.
Roughly.
Why are we even talking about her? Who is she again?
I know.
What did you say?
I forgot. Yeah.
Elizabeth. No.
Poor old Lizzie. And guess what? The private net worth of the entire British royal family is.
Okay, that's got to be.
That is in the billions. I'll give you that.
Yeah, that's got to be. Well, it's a whole family. It's got to be like, I don't know, like 500 billion or something like that. Something massive.
24 billion.
Really?
24
so that's
billion.
it.
Yeah, that's it. So Gina Reinhardt, who, for those that don't know, is Australia's richest person.
The Queen of Australia, by the way.
Mining, miner. She is wealthier than the entire British royal family.
That's crazy. That's insane.
Insane.
I really didn't. Yeah. I really didn't know that. Wow.
And the reason, and it's so weird, and the articles are talking about it, it's like they have this perceived net worth because we think that they own everything. But they actually don't, because not privately at least, because it's held like as a part of the it's held like by the sovereign, like by the monarch in their official capacity, but it's not actually like King Charles can't buy and sell bits of real estate that are in the Crown land. So anyway, let me tell you about it, because I found this really interesting going into it. So they have three main categories to their wealth. There's income they receive for official duties, then they have private income for them personally, and then they have inherited wealth. So in terms of income for official duties, this is called the sovereign grant. So this dates back all the way back to 1760, when King George III was actually just going bankrupt as king. So he actually wasn't generating enough enough income to fulfill his official duties as king. So what he did is they had all of these crown lands owned by the king, all these bits of real estate. And what he did is he actually handed over the crown lands to the government in exchange for an annuity, so just an annual payment, so that he could continue to spend and fulfill his duties as king.
Yeah.
And what's interesting is that was in 1760, and that arrangement has more or less stayed the same all the way up until today.
That's crazy.
So the same thing happens, is that the crown lands are now not owned by the royal family. They're also not owned by the government. They're kind of halfway in between, but the income goes to the government. And the way it exists at the moment is that the monarch gets 15% of the net profit from the crown lands.
Right.
And that income is for their official duties. So it funds all of the things that they have to do as the monarch.
Okay.
And for those wondering, year ending March 2022, that was worth, that payment was £86.3 million, which is equivalent to £1.29 for every person in the UK.
Right, okay.
So that goes straight to the monarch. Well, technically, some of that is a special for redevelopment of Buckingham Palace, but
Right.
but that is the first source of their income.
Yeah.
And then, so that's just public money that goes to them just for being the monarch, but they don't use it privately. It's just for official duties, as far as I can tell anyway. Then they also have their private income, and this is where things get really interesting. So there's a thing called the Duchy of Lancaster. You ever heard of that? That's a bit of a weird name. The Duchy of Lancaster is a property portfolio that is not technically owned privately by the monarch, but is managed with the objective of providing a private income to the monarch.
Right.
Does that make sense?
Yeah.
So yeah, it's really weird. So it includes like agricultural land, commercial, residential real estate. Most of the land is rural, although it also has some spots in London, like the Savoy Chapel and Wellington House. It has some sites in Harrogate, such as Harrogate Ladies College and the Stray. And this is like just a managed property portfolio. Again, not technically privately owned by the monarch. They can't buy and sell bits of real estate for the Duchy of Lancaster.
Yeah.
It's managed as a separate entity and with the sole purpose of providing private income to the monarch. As of March 2022, the Duchy of Lancaster, the Queen's Duchy of Lancaster, had £652.8 million of net assets under its control, delivering a net surplus of £24 million to Her Majesty for the year. So
not bad.
That's pretty interesting. And interestingly, there's also a Duchy of Cornwall, which is the same thing, except that is to supply income to the Prince of Wales, so the heir to the throne.
Okay.
So that was going to Prince Charles before he was king, and it's now going to William, who will be king after Charles passes away.
So it sounds like so far they've just owned a bunch of land, and then they struck some deals with the government and some other deals, and they're just basically generating income off the land, the vast land that they've accrued over time.
It's pretty much just real estate.
Yeah.
They do note, so that's all the stuff that we can privately see as individuals, because we can look at the annual reports of the Duchy of Lancaster. We can look at the annual report of the Sovereign Grant.
Yeah.
Beyond this, the Queen also had a private equity portfolio of an undisclosed amount, because it's obviously
she's
private.
A trader.
she's a
Nancy
Bitcoin.
Pelosi. She's doing insider trading too. It makes sense. All these people. All of their money is just insider trading.
I'm meeting with people from Commonwealth Bank tomorrow. Can I buy some shares before I meet? So there's an equity portfolio of an undisclosed amount. And she also has over 100. Well, she had over 100 racehorses, which won over £600,000 of prize money in 2021.
So she's a degenerate gambler as well. Wow. Okay.
Yeah. Poor old Queen. Poor old Queen Elizabeth.
The more you know.
And then from there, they also have, so that's the private fund, and then they also have inherited wealth. So this is really it's two big chunks of real estate, two big estates, that being Balmoral Castle and Sandringham House. So Balmoral is where the Queen died, and it's where she spends her summers, and then Sandringham House is where she spends her Christmases. And they are two privately owned estates, castles that actually are owned by that family. Yeah. They could sell them if they wanted to. And then she also inherited £70 million from her mother when she passed away in 2002. So there you go. They are the three categories of income for the monarch, for the Queen. So now the sovereign grant now goes to Charles. The Duchy of Lancaster now goes to Charles. The Duchy of Cornwall goes to William.
Yeah.
And Charles is also inheriting Balmoral, Sandringham, and the Queen's equity portfolio and whatever other cash she had.
Yeah, wow. I definitely didn't know. I knew that. So what I'm looking for, I kind of knew that it would have all been from real estate, or a large part of would have been. But I didn't know kind of how the deals were kind of structured. Interesting that they struck that deal with the government, and then they essentially get an allowance.
Fixed payment.
They get a weekly. They get a weekly allowance from.
Which is kind of weird because it's like it's kind of like, oh, this is taxpayer money, but in a way, like it's 15% of the land that they once owned outright.
Yeah.
So it's like you can argue that it's taxpayer money. You can argue that it's also not taxpayer money.
Yeah. Yeah. Is that a fair trade to give the land back to the government? And then I guess now quite a lot of it's probably been sold privately, and I wouldn't know. I don't know about the details of it, but yeah. Interesting.
They also don't. The Queen doesn't own the crown jewels. She doesn't own the royal collection, which is like a art collection of over 1 million pieces.
Wow.
They don't own privately basically anything. There's a lot more people in the world that are richer than them. But there you go.
It's a strange concept.
How interesting is that?
Yeah, it is interesting.
It's kind of that. Yeah, a bit out of left field, but I thought I'd put that in just because I went down a rabbit hole and I was like, man, this is like, I had no idea this is how it all worked.
Yeah.
And now I do.
There you go. I need to. I remember I watched a couple of seasons of The Crown because I did want to kind of learn a little bit about the history of all of that. But I got bored.
I got bored as well.
Yeah, it's all very.
Did you see they're doing another change of cast for the last 2 seasons?
No.
Did you see who's playing Queen Elizabeth?
No. Who is it?
Dolores Umbridge from Harry Potter. You remember Umbridge?
Yeah, I think so. Wait,
I can't remember what the actress's name is.
I'll just look.
But she's like the evil.
Yeah, I think I know who you're talking about.
kind of girl.
Yeah.
Oh.
I mean, I can kind of see it, but yeah.
Yeah, I can see it as well. But every time I look at her, I'm just like, Umbridge.
You just remember that
she
scene
was
with
just
with the pen,
character.
Like, I will not tell lies.
Not tell lies.
Yeah.
Oh dear, oh dear. Anyway.
Yeah. What an evil person.
Yeah, there you go. Should we do one question before we get out of here?
Yeah. Do we have we don't?
Yeah,
we don't have.
We're running out of questions.
You go.
No, so if you guys, I don't know why I'm looking at you. I should look over here at the camera.
Yeah.
If you guys have a question that you would like to ask for the podcast, just head over to the YouTube version of the podcast and drop it in the comments section. You can ask one on Spotify as well. Feel free, because chances are it'll end up on the show because we don't have that many at the moment. I answered this one last week or 2 weeks ago with Tom.
Okay. Do we have another one?
So we do. I'll ask you this because it aligns with what you know, your circle of competence more than mine. Do you think it is fair to compare Netflix and Disney evenly, considering, despite their overlap in some movies, Marvel, Star Wars, Netflix seems to target adults and Disney more children and families?
Yeah, I think there's a couple of things. Obviously, I think there's going to be room for, like, as we kind of spoke about earlier, room for multiple players to succeed. And I think there's going to be a lot of consolidation between these media companies. But yeah, ultimately, I think, I mean, look, they're not, I guess in some aspects, they're direct competitors because they are competing for engagement. But there's clear, distinct segments of audiences, not even just across age ranges, but across different types of content as well, right? Netflix leans very much into television drama, that sort of thing. They have a lot of crime documentaries, for example. There's certain categories they do extremely well. And then, Disney, like Netflix, as far as I know, they haven't done any big blockbuster superhero movies. Maybe they've done like 1 or 2, right? But that's clearly a quite a different segmented audience. So there's going to be different content that serves different audiences, and there's definitely room for for multiple services to thrive, I think, in this space if they can get to a profitable scale. That's ultimately, I think, where we'll see a lot of consolidation, because these businesses will, like even Disney trying to consolidate Hulu and Disney Plus. Well, they're not consolidating them, but bundling them together to try and get their subscriber numbers up, get their revenue up, to get to a point where they can be profitable to produce content. That's really going to be the question, I think. And that's where we'll see either companies fall off and move into licensing more of their content again to generate revenue, or whether they will commit and be producing enough revenue to fund what we know now as kind of the streaming environment. Because I think it's important the same thing is true with kind of delivery companies. It's important to recognize that at the moment, the streaming experience you're getting with HBO Max and Disney Plus, it's a not sustainable experience, because these businesses are not profitable at the moment, at least in their streaming businesses specifically. So we're going to see how it evolves over time. But yeah, they're not, I guess they're not direct. They're direct competitors in some aspects, but in others, they will, people can have
has
both.
Their differences.
I guess it's different in that you're not going to have, some people will choose one or the other, but you could definitely combine both and get more content. So, yeah.
All right, cool. Nice one. Should we wrap things up?
Yes. We're thanks everyone for bearing with us bearing with me over the last week, but yeah.
I'm glad you're better. That's the main thing.
I'm not going to say anything to jinx us going forward, but we'll be back next week. Leave us a question if you have any questions, either on Spotify or on YouTube. And we'll be back. We'll be back next week. So thanks for joining me, as always, Brandon, and thanks to Sharesight for sponsoring. And we'll see you guys next week.
See you later.